So let's see, let's minimize this real quick. There we go. Okay, tokenization and its role in decentralized finance. Let's start. What is decentralized finance, or DeFi? This is a big hot buzzword in the crypto blockchain space at the moment. A lot of companies are getting a lot of notoriety and press around this. Some of them recently because of hacks, so not necessarily for such good reasons, but it is certainly a critical word to know if you're in the blockchain space in 2020. So I'll try to break it down into kind of three general segments. Currently, the largest segments of DeFi or decentralized finance would be basically creating monetary banking services such as issuance of stablecoins. There's a lot of notable stablecoins out there, such as USDT, Tether, DAI, USDC, Paxos. There's all different types of stablecoins which can be backed by all different types of assets, whether that's backed by fiat or US dollars or euros, etc. Crypto assets, or even a kind of basket of assets. Multiple ways to be able to basically create these types of stablecoins. Number two would be providing peer-to-peer or pooled lending and borrowing platforms. This is quite a big one and probably the hottest at the moment, I would say. A lot of interesting lending platforms out there. Some that come to mind would be Nexo, Celsius, but there's BlockFi, but there's plenty out there. Some are a little bit more decentralized than others, meaning some of them are actually kind of centralized lending platforms, but you're basically able to lend peer-to-peer through the blockchain, lending your cryptocurrency to others and generating a yield or interest on those assets, which is kind of interesting because obviously you cannot do that through a bank. And then finally, enabling advanced financial instruments such as DEXs meaning decentralized exchanges, tokenization platforms, derivatives, and prediction markets. So for the purpose of this conversation and this chat, I'll be talking mainly about tokenization or the tokenization of assets, not necessarily the platforms themselves. So what is the potential of tokenization? In short, it is massive. This guy over here, Robert Greifeld, he's the former chairman and CEO of NASDAQ, and he is quoted as saying 100% of the stocks and bonds trading on Wall Street today could be tokenized, and in 5 years, 100% of the stocks and bonds on Wall Street will be tokenized. That is quite a powerful statement from a man who formerly ran one of the largest, basically, tech exchanges of securities in the United States. So even if you have someone like this guy who believes in the prospect and potential of tokenization, you can rest assured that he knows what he is talking about. So what are some of the existing problems faced by both investors and asset owners in the existing capital markets as they are today? So from the investor side over here, obviously you have these high barriers to entry. So generally speaking, if you want to invest in privately issued securities or even publicly issued securities through IPOs, you have to be an accredited investor. I'm speaking specifically from the US, but generally speaking, you have to be an accredited investor, meaning that you have a certain amount of dispensable income, which is quite high, and generally speaking, the average Joe does not have the ability to reach that threshold. And then, of course, lack of liquidity on traditional exchanges and long lockup periods. It seems to me that we might have a question. Let's see. Oh, that was to me privately. Anyway, I'll get to that later. On the asset owner side, narrow range of investors, meaning you're only able to, again, reach out to these accredited types of investors. You cannot touch retail for most types of issuances. Expensive middlemen, you have investment banks and brokers who are taking cuts and basically are effectively jacking up the price on these types of issuances, making them expensive for the issuer themselves, and basically taking a big piece of the assets that could actually be used for whatever you need to run your business. And then, of course, there's a high cost of paper ownership. It just makes sense in this day and age to go digital. All right. So 13 trillion, this number. By 2027, 10% of the world's GDP will be stored on the blockchain. That is pretty massive. To put that into perspective, the US's GDP for 2019 was about $21 trillion. Obviously, this is a big number to say, pretty unfathomable, but effectively this is saying that the potential of where we're at today is just a very small drop in the ocean, and this is said by the World Economic Forum and OECD. So what are the different types of digital securities out there? You can effectively tokenize anything. Tokenization is basically just securitization in the traditional sense. Securitization meaning, taking some sort of asset, whether it's equity, debt, real estate mortgages, pretty much anything, and bundling them up and creating a security type product that's then able to be sold, traded amongst individuals. You can effectively think of the global financial crisis as not the first case, but one of the cases where securitization kind of unwound itself and we had quite an issue. But when you do it in a more, let's say, structured and proper manner, there are ways to make sure that that doesn't happen again. And that wasn't only because of securitization. There was a lot of different things going on in that specific situation. But anyway, in terms of types of digital securities, you can really tokenize anything. Like I said, you can tokenize the equity or debt of a company. You can tokenize a fund, so an investment fund. You could tokenize the LP interest. You could tokenize buildings, which I'll talk about. You can tokenize commodities from gold, which I mentioned earlier, to diamonds, to wine, to cars, to mega yachts. I've seen people who are trying to tokenize mega yachts. Obviously, most people can't afford a mega yacht, but potentially with tokenization, you could afford 1/100th of a mega yacht and use it as somewhat of a timeshare. You can tokenize exotics such as art, other high-ticket items, and then of course intangibles, copyright, IP, voting rights, etc. So really, you name it, you can tokenize it. What are some of the values? The value of tokenization. Basically, similar to crypto markets, there's 24/7. They are tradable all the time. You have this niche market access of being able to tokenize fine wine and mega yachts and things of this nature. You can access global capital. So as long as you're doing it compliantly, you can raise capital from all around the world. Whether you're an asset issuer in the United States seeking capital in Malaysia, for example, as long as you do it compliantly, this is certainly possible. And then that fractional ownership piece is also very important, meaning that, again, you don't have to own one whole mega yacht. You can own, 1/100th or 1/1000th of it. Again, because of the blockchain and digital ledger technology or distributed ledger technology, you can lower the cost for these types of issuances for the asset issuer themselves. And you can program these types of governance rights or economical rights into the actual token itself. I think I'm getting a fair amount of questions. Let me see if they're private or not. Okay, let's see. Great GPT, hi Amber. Oh, hi Amber. I like the graphs. Anyway, let's go back. So let's talk about some use cases. I think this is one of the very cool tokenization use cases that's existing today, which is the contract tokenization of NBA professional athlete Spencer Dinwiddie. So he was the first athlete ever to tokenize their contract. And effectively what he was trying to do was basically took a portion of his NBA deal with the Brooklyn Nets and was saying, okay, you give me the capital up front. I will then pay you back with interest, but I'll also have some upside in the token, meaning that if I hit my player incentives, such as making the NBA All-Star game or scoring a certain amount of points per game, or maybe we make the playoffs, he also has financial incentives in his own contract that then he could pass back to the token holders. Unfortunately, in this specific case, the NBA did not like that so much. He is definitely a groundbreaker and kind of the first person who is doing this in the first place. So effectively, the NBA basically wasn't too keen on having him test this out in a bit of a crazy way. So they really dulled. They really dulled down the actual issuance itself, and it's really just more of a bond type asset. So it has a 4.95 yield paid out annually. Actually, it's paid out monthly, I think, but annually for 3 years. And he's raising approximately $13.5 million. It's kind of an interesting deal at the moment, I would say, because, well, let me get into it on this side. For an investor, you have access to the financial upside. So again, in this specific case, there wasn't able to have that upside because of the NBA basically shutting it down. But on future deals and issuances, I'm sure that there will be some element of financial upside. Currently, I would say it's a better yield than a lot of other similar type risky assets out in the market. 5% in this market is not so bad, particularly when interest rates on other type of short-term bonds are close to zero, if not negative. And then, of course, because it's a token, there is the ability to trade that 24/7, 365. On the athlete side, he gets the immediate access to $13.5 million. Normally, an NBA player, they get paid, similar to any other, professional out there. You get paid, on a monthly basis. Of course, they get paid a lot more than most people, but still, in this case, he's able to access that capital immediately. So from his side, he thinks, I can make more money now, time value of money. I can make more money now than I could, if in the future. So if I can get access to $13.5 million at a 5% interest rate, and I can make 10% on that $13.5 million, I'm in the money big time. So that's kind of the thinking that they are having. And to be completely honest, if you're a professional athlete, you get your money up front. Who wouldn't want that? Another big use case has been real estate tokenization. I don't think this is as sexy or as interesting, but basically you're tokenizing a portion of a real estate building or even a even you can even tokenize like rooms in a hotel or something like that. You could really tokenize anything in real estate. But in this case, St. Regis in Aspen was one of the first tokenized real estate projects to do it. They raised approximately 18 million bucks US, and each digital token represents an indirect ownership in one deposited share of the common stock. So basically it's a REIT, and the REIT basically provides this tax efficient structure, and the blockchain allows for that peer-to-peer investing for individuals across the world effectively. This is traded on some exchanges at the moment, but to be completely honest, one of the issues with tokenization at the moment is there are a lack of truly legitimate exchanges with high liquidity, just because it is such a new field. So some buy side benefits: democratization. So most people could not buy the St. Regis Hotel. But you could buy, a room there, and every time you go on your ski trip to Aspen in the winter, you could, use it. But at the same time, you can also potentially make a yield on it from an investment perspective through rent, and then through appreciation of the asset itself. And then again, similar that you have full control of your portfolio because of the high liquidity and 24/7 tradability. As I mentioned, high liquidity is and it is a proposed benefit. It is not exactly occurring at day one. From a real estate project, you do actually have a lot more access to types of investors. You're able to raise capital from much smaller tickets, so you can diversify the book and to distribute that risk in that sense. So I think I'll stop there, and kind of open it back up for questions in case any of you have them. Let me go back to my presentation, stop the share. All right. So, Jorge, the mechanics of tokenization are straightforward. Yeah. Oh, George. Oh, George.
Okay, yeah, George. No problem. That's okay. Jorge,
go ahead.
George, that's no problem. Yeah, I'm involved in a few of these tokenization projects as well.
Okay,
I was also a speaker in the previous Unity event a few weeks back. But I still, and this is my question to you, I still think liquidity remains a big issue with this tokenization. I think the mechanics of tokenization are straightforward. I think there is legislation and regulation now in several countries, Estonia, Gibraltar, Zug, sure, which is not a country, but I think liquidity still needs to be solved. What are your suggestions or approaches to help?
Yeah, of course, I think that's probably the number one issue facing the market right now. To be honest, I think the first thing that's going to solve this is having high quality projects and high quality assets that are tokenized, where you have a very solid book of investors who are willing to actually trade these things. This isn't like the ICO boom days where you have, hundreds of thousands of retail investors getting in. To be completely honest, using the example of the Dinwiddie deal, the professional athlete deal, they only have 90 tokens. that's available, because the minimum ticket size is $150,000 US. So in this specific case, it's not like you're truly allowing Joe Schmo and Main Street to come into these deals, but there are places where that is possible. So I think starting with truly high quality assets is the best place to begin. We've definitely seen that there's been a trickle over from the ICO days, where you're having early stage startup projects where, let's be honest, the assets are not either even possible to be valued yet, and it's basically like venture investing, where you're trying to figure out if this is going to be the next $1 billion idea, but 9 times out of 10, maybe 99 times out of 100, it's not. And there's obviously inherent risk there. So the higher quality assets that are tokenized, the higher quality investors you're basically going to be bringing in. And when you have these higher quality investors, I do believe that liquidity issue will not necessarily be immediately solved, but that will at least be the first step in the right direction, I would say. Does that make sense?
Yes. Let's take, the devil is always in the detail.
Of course.
So let's take one example only, because I think here is quite, the one that I'm specifically interested in is real estate. So let's assume you're trying to build a real estate project. It's tokenization of either an existing building or one that you're about to build. Let's say, I don't know, you can pick an amount, $10 million or whatever. So typically when you deal with real estate, you're not going to have access to the money liquid, because you want to collect the money to build the building, or take the money to operate the building. So it's not like the cash is going to be liquid. I'm sure people can definitely trade the tokens based on their perceived value, but it's not like the token. It's not like the token is going to be liquidated immediately. It might be liquidated after 5 years or 10 years, and this can be protected through smart contracts. But what is your views on this, and how to address this perception that liquidity is not necessarily mean liquidity you can sell right away?
Of course. Again, it definitely does depend on the underlying asset that's being tokenized, right? And in your specific case in real estate, yes, they might be liquid on a secondary market, exchange market, but the actual asset underlying is not necessarily liquid itself either, right? So then it comes down to time horizon. So, maybe the project you're expecting returns in the traditional sense in, 7 years. Are you willing to, take a token that might be liquid in, 3 to 5? For some people, that might be worth it. That I think that again is a bit of a case by case situation. So there's definitely two sides of it. Actual liquidity in the market, and then actual asset liquidity. Real estate is obviously not an inherently liquid asset by nature, but you could potentially have a tokenized version of that, which is a little bit more liquid. I think Warren has a good question. So I said that the question is, you said earlier that stablecoins are an example of DeFi. How can stablecoins be decentralized? Very good question. I think when we talk about DeFi, you have obviously levels to it. There's definitely companies that are issuing, or doing let's call it DeFi activities, which are definitely not decentralized businesses. You know what I'm saying? I would say kind of the closest we're getting there would be MakerDAO, which is probably the closest to being a DeFi stablecoin issue. A decentralized autonomous organization by nature is decentralized. A lot of the people who are issuing stablecoins are not necessarily decentralized companies, but they're using them for decentralized services. So, not saying that immediately because you issue a stablecoin, it is DeFi, but I think it is inherently valuable within DeFi products, and you can get to a point where you could have more decentralized stablecoins. Also, to the point of what I think I was trying to get at with that comment was basically that stablecoins are in effect creating monetary banking services. So that is effectively going past like the Federal Reserve and issuing your own form of, in essence, currency. Like USDT is similar in the crypto world to a certain extent. Obviously, not spending it at the store, but it has a similar, I guess, understanding as US dollars, right? It's literally supposed to be one-to-one. Is it one-to-one? That's a different question. But it is effectively going past the monetary banking authorities and issuing them on your own, which in essence is a little bit decentralized, I would say. Does that make sense? Does anyone else have any questions they would like to ask? And if you don't, have any questions now, feel free to add me on LinkedIn or I'm more than happy to drop my email in the chat later for anyone to give me a shout or ask for a copy of the presentation or anything like that. More than happy to chat with anyone. I think tokenization in general is quite an interesting topic. It's definitely hot. People for sure thought that STO was going to be the next big thing after ICO started to fade. Has not been the case, probably for the better. ICOs, were good for time and place, but they also had a lot of negativity behind them. A lot of people lost a lot of money, and it to a certain extent gave a little bit of a bad name to the crypto space. But I think these types of regulated offerings are meant to be not meant to be a replacement for ICOs, of course, but they are meant to add value to an outdated process, which is capital raising, particularly for small and medium enterprises, I would say. Or a big thing is the size of the issuance, right? Raising $5 to $10 million for almost any investment bank is a no-go, right? Maybe even 50 million is too little for a lot of people. So there is a gap between the actual asset issuers who need help raising capital from the market and the banks or the brokers who are actually being able to help facilitate these capital raises. I think there's a definite sweet spot between let's put it this way. It's probably harder to raise $5 million, maybe even $10 million than it is to raise 50 sometimes. And the reason for that is at that size, 5 to 10 million, it's not that easy to get enough family offices or high net worth investors, high net worth individuals into the deal. It's big enough that most people don't want to take a huge enough slice, and it's not. Well, let's say it's too small for institutions to really come in and put in a sizable chunk of capital. So that is definitely an issue that's plaguing the market a little bit too. Is what is the sweet spot in terms of the amount needing to be raised for these issuances? What is the asset that is really attractive for investors? I think one thing that I've seen is that because a lot of these people are coming from traditional background, they understand the value of the asset because they are in essence securities. They have valuation methodologies that have been tried and true and proven for years. But they also believe that there is potentially more risk because this is a token and tokens are bad, kind of thing, particularly if they're more from a traditional background. So they're always asking for the upside, so back to the case of the Dinwiddie deal. They took away a lot of the upside because of the way that the NBA just didn't like the structure of the asset, which is unfortunate, I would say, but it is just the beginning. I believe that once this deal is done, I think that there's going to be athletes left, right, and center who are going to want to do this because, what athlete or musician or, rapper or singer or, whoever, TV star doesn't want to, take their contract up front and be able to go get themselves a watch and a car and, do all of these types of things that you see the movie stars and the athletes and the artists, musicians doing. So, there's definitely an interesting asset class behind that, whether or not it's going to be the one that sticks and becomes the most utilized or I guess the one that's, the killer asset that's for tokenization. I don't know. We'll see. And it's going to take people, I guess like George, who are tokenizing things like real estate and, other different things to truly, kind of pave the way for this to take off in the future. I don't have too much more to add, but again, if anyone has any questions, I'm more than happy to take them in the last couple of minutes before I hand it over to the next person.
Hey, Nick here from Amsterdam.
Hey Nick, how's it going?
Thank you for your contribution so far. Great. Can you maybe elaborate on where you're going with the Rio Exchange and where you actually see the market heading and where you want to put your eggs in the basket on?
With Rio Exchange?
Yes.
I wish I could tell you more, but I actually can't talk about that too much since we're not exactly public yet.
Fair.
But I do appreciate you asking. Yeah, so little shill. Go check out Rio DeFi, which is the company I'm advising, which is a public blockchain based off of Parity substrate with a lot of different DeFi products, including savings and lending, wallet, payment rails, all different types of things. One of those is an exchange, but again, not necessarily public just yet.
Okay,
but
fair. Well, maybe
we'll be out in the near future. So maybe let me answer the second part of that question. Could you repeat that one?
Well, maybe the another question: if you really, if you think back of the 2017, 2018, it was a big craze. People were also dreaming very far, but if you actually look at the current market and you still dream where things, you think in projects that actually will get realized, where from this current point of view and the next 2 years, where do you see things going in terms of DeFi?
Sure. Yeah, I mean, I think this year for DeFi has been, lending. You've also seen hacking.
Yeah.
And then you've seen returning of funds. I think within the span of like 2 or 3 weeks, there was like 2 or 3 hacks. The hackers got caught and the funds got all returned. So I think what needs to be fixed first and foremost is you need these DeFi products to secure themselves. There is a reason why traditional financial services still have value, and that's because they're tried and true. They have the highest end security measures. You don't necessarily see JP Morgan getting, you might see the branches getting robbed, but you're not seeing them necessarily losing millions and millions of dollars of customers' funds, which isn't at least insured. So insurance plays a big play. There needs to be more backstops, capital reserves and backstops, which can of course give more soundness of mind and peace of mind to the investors or to the people who are using these types of products. And then I think you're just going to see all different types of financial products that have existed in the traditional world start moving over. You'll see more decentralized derivative products. You'll see, and I think you'll also see that you'll have pickup and adoption in a lot of places where they just did not have access to traditional financial services in the first place. So if you take China as a good example, not saying that they're using DeFi products, well they are, but like as a whole populace they're not. But they went from having no bank or banking solutions really to being able to effectively put it in their hand and get access to financial services. DeFi is going to do that in other countries big time. Southeast Asia I think is a hot spot for this. Indonesia, Thailand, Philippines potentially, South America, and Africa. These are the places where the traditional financial sector has, I don't want to say failed the people, but it has underserved them. And that is exactly where we want to go, because these are the people who are, generally speaking, young, growing populations. They're generally technically savvy, and they have a need to access financial products, but they don't necessarily have the ability to. But they could do it through a smartphone, right? So that's where we want to be. That's where I see us going in the next couple of years. But I do see a lot of, you don't want to reinvent the wheel, right? There's going to be new products that we're going to create on our own, but the traditional world is going to be a lot of inspiration in terms of types of products that we could just maybe do in a better, more decentralized way.
Thank you.
So yeah, no problem. I think that's enough time for me today. So thank you very much, guys. Hope you enjoyed it, and have a great weekend ahead. Oh, and then let me send my details in the chat to everyone in case you're interested in getting in touch. Alrighty, have a good one, guys. And if anyone wants the slides, let me know. Cool. Bye-bye.